Welcome back. We are discussing on time value of money today under the course financial management. And time value of money is actually a very core concept in financial management. And when we talk about what's the meaning, it's actually a fundamental principle in financial management, which provides or states that money today is worth more than the same amount in the future due to its earning potentials. And you can see that the cost of buying a particular thing last year is not the same thing as we buy a particular thing. Maybe the cost of buying a Toyota Corolla car last year, possibly maybe it is 4 million, and going to the market to price the same car is today, I bet it would have increased. So this principle is stating that the money today is worth more than the same money in the future. You have to spend more in order to achieve what you need to achieve in the now for the future. So the concept is essential for investment decisions, loan evaluation, and capital budgeting. Having an understanding of what time value of money is allows financial management to compare cash flows occurring at different times and make different choices that maximizes wealth. And that is why we'll be looking into those key components of time value of money today. And those are the present value and the future value. We'll look at the annuity and perpetuity. We also will be looking at the compounding and discounting technique. I want you to listen very attentively, and the note is available for further reading. What is a present value concept we are talking about? A PV is a current worth of a future sum given a discount rate. It is the current worth of a future sum given a discount rate, and it helps to assess if the future returns justify the current investment. We see the formula for PV there, which is the future value over 1 plus into bracket 1 plus R raised to power n. And for example, where there is 1 million naira, which is expected in 3 years at 10% discount rate, the PV will actually be 751,315. What does this mean? It actually means that 751,315 today is equivalent in value to the 1 million naira received in 3 years. So just like I said the other time, so the value of 1 million naira in 3 years will be 751,315 in today's world. So, and that's assuming it is 10% annual discount rate. So what are the cases where present value is used? The first is it is used in supplier's credit evaluation. It's also used in investment cost versus future benefit, and also the planning for future obligation. For future value, it is the amount to which a present investment will grow over a certain period at specific interest or growth rate. So it is the amount to which a present investment will grow over a certain period at a specific interest or growth rate. And for instance, where there is 500,000 invested at 12% for 5 years, the growth will be 881 naira 105, 881,105 naira rather. So this means that if you actually invest that 500,000 naira today at an interest rate of 12% per year, after 5 years, you will actually gain the 881,105 naira, which is the future value of that 500,000 that you will have to invest today. So what are the cases where future value is used? The first is in calculating savings accumulation. setting long-term goals, and also estimating future capital cost. When we have to compare present value and future value, we talk about decision making. That is, PV helps decide how much a future benefit is worth today, while future value estimates the future worth of today's investment. As it pertains to cash flow timing, managers uses both concepts to time cash flow effectively in operation and capital projects. In terms of financing choices, both PV and FV allows managers to decide on the best source of finance, which is equity or debt, by comparing PV of future repayment. How do we apply PV and FV to that's present value and future value in financial management? When we talk about using it for investment appraisal, it helps to determine if future returns justify the initial outlay. And for loan evaluation, it helps to assess if borrowing cost is worth future use. Also, for pension planning, it helps to ensure investments meet future liabilities. And future for bond valuation, it applies to financial management where the prices bonds based on PV of future payments. And for capital budgeting, it uses PV in NPV and IRR, which is internal rate of return and net present value calculations. We will look further into annuity and perpetuity. When we talk about annuity is a series of equal payments at regular intervals over a fixed period. It is a series of equal payments. I want you to note that equal payments at regular intervals. And this can be, which are the types of we have the types of annuity to be the ordinary annuity, which is payment at period end, and annuity due, which is payment at period start, which is fixed annuity and variable annuity. So we have the types to be the ordinary annuity, we have the annuity due, we have the fixed annuity, and we have the variable annuity. And annuity is used in examples such as loan repayment, insurance premium, pension or retirement income, and equipment leasing. For perpetuity, a perpetuity is a stream of equal payments. The first is a series of equal payments at regular interval. This one is stream of equal payments made at regular interval forever. That one is for fixed period. This one is forever. Since the payment have no end, we cannot compute the future value. However, we can compute a present value based on the required rate of return. And the example where perpetuity is used are the preferred stock dividend, government consoles, and the endowment or the charitable trust. When we have to calculate the present value and future value of annuity, we have it there for our ordinary annuity. It determines the current worth of equal future payments. And the example is a company leases equipment for 200,000 annually for 5 years at an interest rate of 10%. Using the formula, we will be able to arrive at a present value of 758,157 naira. And for future value of ordinary annuity, now it shows the accumulated value of regular investments. We also have the formula there. For example, a company saves 50,000 annually for 6 years in a fund earning 8% interest. The future value shows the total amounts available at the end of the 6 years. So 50,000 annually for 6 years at 8% grows to 366,796 naira, which shows a very good investment. And also we have the compounding and discounting technique. The compounding technique is used to calculate future value by applying interest over time. More frequent compounding, which is monthly and quarterly, yields higher return than annual compounding, and that leads us to the types of compounding techniques that we have. And these types include the following, showing when interest are added to principal. And from what was said before, the monthly and quarterly yields higher than when we talk about the annual compounding. So the types are the annual compounding, which is once a year, semi-annual compounding, which is twice a year, quarterly compounding, which is 4 times a year, and monthly compounding, which is every month, and continuous compounding. This does not have any number of times in a year, it is infinite. So it's an infinite number of times per year. The discounting technique is the reverse of compounding technique. It calculates the present value of an amount expected to be received in the future. The present value of the amount which is expected to be received in the future. It helps determine what a future sum is worth today. Given a specific discount rates, usually the cost of capital or required rate of return, and it's essential for evaluating future income, NPV, IRR, and investment decision. How is it important in financial management? It's important in evaluating future income, also for NPV and IRR calculation, also for valuation of bonds and stock, and lastly, for investment decision making. In conclusion, it is very important to look into the time value of money as an investor or a financial manager. So, talking about the TBN fundamentals, we've been able to look that money today is worth more than in the future due to the earning potential, and the core concepts has been discussed, which is the PV and the FV, the annuity, perpetuity, and compounding and discounting technique has been looked into. Looking practically into it, the time value of money hits investment appraiser, the loan structuring, pension planning, and valuation. It requires careful assumption about rate inflation and risk. And when talking about the strategic financial decision, mastering TVM empowers managers to make informed choices that maximize wealth and align with organization goal. We have more notes. We have the calculations that are available in the notes. You can go check them, and thank you.